Hello everyone, I'm Miles. Pick up your pen. Today, in Solvito Learn's problem-solving session, we're going to learn some more complex and interesting accrual accounting cases. Today's case is, on January 1st, 2025, the company signed two contracts. Contract A, services worth $120 delivered immediately, payment collected next month. This accounts receivable. Contract B, $240 collected in advance as deferred revenue for 12-month subscription, delivered monthly, with 20% tax rate. Question. On January 1st and at end of 2025, how are these transactions reflected in three major financial statements? Income statement on January 1st. For contract A, $120 in revenue is recognized, and after tax, net profit increases by $96. Although cash has already been received for contract B, since the service hasn't been delivered yet, it can't be recognized as revenue. This is a classic case of deferred revenue, also known as unearned revenue. So the total recognized revenue is $120, and after tax, net profit increases by $96. The cash flow statement starts with a net profit increase of $96. Accounts receivable increases by $120, so CFO decreases by $120. Deferred revenue increases by $240, so ECFO increases by $240. The net CFO is an increase of $216. If we use the formula CFO equals net income plus depreciation and working capital, then working capital equals $120 minus $240, which is negative $120. Net CFO equals $96 minus negative $120, which is an increase of $216. On the balance sheet, cash increases by $216. Accounts receivable increases by $120, so total assets increase by $336. On the liability side, deferred revenue increases by $240. On the equity side, net profit increases by $96. Inflow to retained earnings, equity increases $96. Total increases $336. Balanced. Year-end income statement, $240 contract B recognized revenue, $120 contract A. Total revenue $360. Paying $72 taxes. Net profit tax increases $288. On the cash flow statement, starting with a net profit increase of $288, the annual change in accounts receivable is zero. It increases by $120, then within 30 days, $120 in cash is collected, so the change is zero. The annual change in deferred revenue is zero. It increases by $240. Then as services are provided, $240 is reduced at year end, so the change is zero. CFO equals NI plus 0 minus 0 minus 0 plus $288. Accounts receivable collected, deferred revenue recognized, net change zero, CFO equals NI plus $288. Balance sheet, cash increases by $288. Accounts receivable cleared, assets increase by $288. Liability side, deferred revenue cleared, no change. On the equity side, net income increases by $288. The inflow goes into retained earnings, so equity increases by $288, totaling $288. Balanced. The real point is that accounts receivable AR causes profit to appear before cash. Deferred revenue U2 causes cash to appear before profit, but in the end, both will reflect the true economic reality. The essence of accrual accounting is not about chasing cash, but about matching performance with reality. Once you understand this bridge, you truly grasp a fundamental concept of modern finance and investment banking.